Hey everyone, welcome back to my channel. Today I will be introducing a new series called Confluences. This will be an exciting and long series, and it will be packed with a lot of information on how the markets truly move. The first episode is on standard deviations, so let's get into it. First thing we must ask ourselves is, what are standard deviations and how can I use them as a confluence? Standard deviations show the size of the move, aka the expansion, of the major move. The size of the manipulation determines the size of the expansion. Do not let that fly over your heads. Listen again. The size of the manipulation determines the size of the expansion. Now, you might ask yourselves, this is all BS. How does that make any sense? Because when a manipulation is larger, we take more liquidity, and more liquidity equals more volume for the move up. Now here's a gem. Volume is shown by the bodies of the candles, so you can see huge buy candles as you can see here. The first example I'll be sharing is the standard deviation right here. So how you mark it up is you mark out the low of the move to the high of the move that the structure broke to create that initial market structure shift. And clearly you can see we have a clear sweep of liquidity right here, and then we have a break of market structure. So this move is going to be the one that will cause the expansion. Now you just pulled up this random Fibonacci, you can say, right? But here's the rule with standard deviations. The way that you know that price is going to make this expansion is by knowing where the move is coming from. So here you can see that price has entered into this daily fair value gap and has respected the 50% of it. So simply what you do is of this overall range, so this high and this low, that's the range. So now what you do is you go to the hourly and you see where the market is going to break hourly structure. So here you have the low, and then here you have the high. And as you can see, the Fibonacci settings are from 0, 0.5, 1, -1, -2, -2.5, and -4. And the numbers are right here. So the way that we use this is you expect price after the expansion happens. You expect price to have a small retracement or a big retracement from the 2.5, -2.5 area. And then you expect an even bigger consolidation or expansion of the -4 level. So essentially here in this range, you're going to expect a consolidation, right? And tell me that did not happen right here. Price respected the edges of these areas, right? Right here, right here. It respected it. So here, if I were to take an entry, it would have been right here, right at this order block. And if I were to get an entry, if this was in my kill zone, right? So this is 4 o'clock. I wouldn't have entered right here. But if I were to, I would have targeted this high. First, I would have targeted this high because this is where you're going to get a retracement, right? So here you got a retracement, and then price expands to the 4 level and then gets a deeper retracement and then a consolidation. So here on this day, I knew that price, or I knew on this area of price action, I knew that price was going to consolidate before a move higher because we have reached a major area of resistance, which is this 4 level of standard deviation. So here it is. First of all, I just want to say that this is not mumbo jumbo. This actually works. So do not doubt yourself after I said everything here, because everything I use here, there is logic around everything I teach. Price needs to come into a logical area to reverse, then you can use this tool. So the logic is price comes into this daily fair value gap, and then I will use the standard deviation to see my expansion, right? Let's look at another example on the 4 hour. On the 4 hour, price, right here, price comes in to a daily fair value gap, right? And then here we're going to expect an expansion. So price here, you will simply put your Fibonacci from the the low, and then the high, and then you will target 2.5, right? So here, price moves up and then gives a retracement. And essentially, I'm going to give you guys another gem here. You can use this as a turtle soup, right? So after this expansion happens, this is your high, which is your inducement. So you can simply take an entry above this high, and you can, as a turtle trader, they normally have bigger stops. I would never have this stop, but I would simply look for sells all the way down to a logical area, which is this daily fair value gap area, right? And here you could have caught this trade. And the reason, the logic behind it is you expect a reversal at the 2.5 area. So here, 2.5, we get a reversal, right? So this is logical. There's a high. After we break structure to a high, we always get a retracement. So here, we get a retracement, if that makes sense. And we come from a logical area. And you can see how I marked it out too. Price breaks structure right here, and price runs liquidity right here. So this is a valid area to look for our expansion because this is an expanding market. All right, so next, here's another example. On the weekly time frame, NASDAQ right here. Price simply has our low and has our high. So here, price broke structure, and this is our expanding leg, right? So here, you're going to expect some sort of retracement. So here, price retraces, consolidates, and then comes to a logical area, which is this fair value gap, respects it, and then pushes higher. So price retraced from our level. So simply, you could have taken a long right here. And why would you take a long right here? Because there's a fair value gap. And then take a long, target the 2.5 or the 2 to 2.5 area. And then simply catch a retracement trade all the way down to here, which is our bullish discount fair value gap. So this is how you catch and target the standard using the standard deviations. All right. Here I'm going to mark out another example that I have not even used. I haven't even looked at. So we looked at our low to our high, and simply the 2 to the 2.5 area, you will get a retracement here, right? So after you get a retracement, you would expect a move higher, essentially, if you were actually bullish here. But remember, the 2 to 2.5 area is actually a reversal area slash retracement slash consolidation. So price can simply reverse and come down if it wants to, lower than this. But I personally have a bullish bias, and I think that we're going to go higher. All right. So this is also how you would expect turtle soups. Now, let me look for another example right here. We have this high, and then we have this low, and we have this standard deviation level. So price comes in, closes right below it, then comes back, and then starts pushing above it. So this is another valid area. Maybe if we go into the 4 hour, it'll come right into the 2.4, 2.5 area. So this, you can see this -4 area right here. This is a big retracement area. Price simply, I just want to mark it out for you guys. This is the 2.4 area. Let me just delete this. 2.4, or I'm sorry, 4.0, price retraces. And then here, you can see that this is our expanding leg. Right here to right here. 2.5. Reverse. Drop. This is gold, people. This is insanely packed value. All right. I appreciate you guys watching this video. I pray that you guys can send this to another person and like the video, comment, so that you can help me reach a wider audience. And subscribe to and turn on post notifications because we have a lot of content coming out like this. I hope I helped. Stay blessed. I'll see you in the next one.